everyone, and welcome to our first video where we're going to demystify the concept of accounting and show you what this wonderful subject is all about. I have prepared a presentation for you on the first basic steps and first basic concepts on what accounting is actually all about. And I hope that you're going to enjoy this journey with me and that you're going to see that accounting is actually such a wonderful, logical subject. So it all starts here. Whether you're in grade 8 or in grade 9, if accounting is a bit of a mystery to you, I suggest start with this video and recording and see if what we are talking about in this video does make sense, and then you can take it further from there. So let's dive right in and see what this is all about. Very, very important. When we work with the subject accounting and all that is included within accounting, there's a couple of basic rules that you do need to understand. A little bit of accounting is parrot learning, where you have to go and learn the basic rules, the foundation, the small bricks of accounting. And from there, once you've got that knowledge, then you can start arguing about things within accounting, and then those things will start to make sense. So the very first thing that you must always understand, and most of you will use accounting and will come across accounting within your classroom environment, where your teacher will most probably give you an activity or an exercise to do, where you will need to record the transactions of a specific business. And as you go along throughout the year, you will be dealing with many different businesses. In grade 8, we focus on service businesses, and in grade 9, we move on to trading businesses. But one thing that I have come to realize over the years is if you form a picture in your head of a business that perhaps either your parents or guardians are running, maybe many of you have your own businesses going already, or at least think of a business that you might want to own or run one day. That sort of helps to put things in perspective and not just keep it at on a theoretical level, but it brings it closer to home. So the very first rule that you need to understand is when we deal with accounting, the business, the actual business and the owner of that business need to be kept separate. And when we talk about keeping them separate, we are talking about especially financial transactions. Now, I know that many people have their own businesses, and this might be small businesses like sole traders or one-man businesses, as we call them, or even bigger businesses with lots of employees or maybe branches across the country. But often owners will be so involved in the business that the owner's finances cannot be separated from the businesses. Those are the people who put in the till a little slip that says, I owe you, or I owe the business, or use the business bank card to pay for personal expenses or purchases and so forth. When there is a business, when the owner starts a business, the owner of that business must realize and remember that his or her financial transactions must be kept separate from the businesses. And we're going to look at that as we go along, but keep that in mind as a rule, as a basic rule for accounting. And even if you have your own business one day, this is very important so that we can see and determine through the recording of financial transactions whether this business is actually making a profit or not. I often say to students in my class, listen, it would be lovely to have a business, and but with owning a business, if I'm the owner of the business, that business needs to make money. Owners of businesses put in a lot of effort, a lot of time. It's long hours, it's stressful. And if that business doesn't even make a profit, why are we doing that? But the only way to determine whether the business is making a profit or not is to keep the financial affairs of the owner separate from the business. And we will have a look at that. Next, very important thing is that you always need to look at transactions. Now, remember, you and I, or if you're sitting in a class, you are the bookkeeper of that specific business that you're busy with at that time. We are the business. So if I talk in any of my recordings or videos about we or us, then we are the business. So whenever us as the bookkeepers who need to go and record the transactions for a specific business, look at it as a specific transaction, and we read that transaction, we need to look at it from the business's perspective. So what does that transaction mean for this business? Not for the owner, not for the clients, not for a supplier. What does it mean and what effect does it have on this specific business? Very, very important. And then, I don't know about perhaps your teachers, but in my classes, I continue to moan about the accounting equation poster or the accounting equation table. I'll get to that just now, but this is one of the really, really important things that you need to know in accounting. The actual accounting equation, what it is and how does it work. And then I actually provide you with a whole poster to explain to you the full working of the accounting equation. And if you understand that, or firstly, if you know that, then I promise you, you're going to understand much more of this whole subject called accounting. So the accounting equation is one of those basic things that you need to understand and know. And then a rule that you've probably heard before, if you're in grade 8, maybe not yet, but we are going to work with this continuously. In accounting, we say for every debit, there must be a credit, and that just means we're talking about left hand left hand and right hand, and what you do on the one side you need to do on the other side. This will be explained much more in detail as we go along. So if we move on to the accounting equation, maybe you've come across this already. Grade 8s, this might be new to you. Grade 9s, you've dealt with this quite a bit in the previous year already. So the accounting equation was established or brought together by the clever people many years ago. And this will always stay like this. This equation will always stay like it. And there is a lot of important information in this accounting equation. And if you understand this equation, then lots of other things will make sense and fall into place. So the equation says assets in the business, and remember, we're looking at it from the business's perspective and point of view, assets in the business are equal to owner's equity plus liabilities. Now, maybe you've come across the concept of assets. What is an asset? Now, if you just look at listen to the meaning of the word, it's something of value. If I say you're an asset to this organization, it means you are valuable to this organization. And assets within a business are things that have value for this specific business. Now, I want to show you what I do in my classes and what I show my students in my classes as well. So to simplify this a little bit for us is what the business owns. Okay, now I probably need to write with a color that we can actually see. Nee? So let me use that one. Right, so what the business owns, and we'll talk about that just now, equals what the business owes. All right, and that is actually how simple the accounting equation is. Now, why do I say that? Let's start with something very, very simple. The owner, and remember, we keep the owner and the business separate. The owner who is starting his business now, today, né? He's taking 100,000 Rand of his savings, and he's going to use that to start this business. So the owner gives this 100,000 Rand to the business. All right. And nowadays we transfer the money directly to the business's bank account by EFT because it's very dangerous to walk around with a lot of money in there. So the owner transfers his 100,000 Rand to the business's bank account. So now the 100,000 Rand lies within the business's bank account. Do you agree that the business now owns that money? It's an asset to the business. That cash is an asset to the business. Now we will see that it's a current asset. We'll get to that. But that money is an asset to this business. But do you agree that the business actually owes that money to the owner? I mean, it came from the owner. He gave it to the business to get this business going. The money is now in the business's account. But the business owes this money to the owner. And that's why people start businesses. They invest that money in that business. They give the money to the business. But obviously, they want this business now to work with this money and then turn this money and turn the business operations into a profit, into more profit. So that 100,000 Rand is owed to the owner by the business. Now, on this side of the equation, it actually shows us that the business can owe money to basically two, let's say, institutions. First of all, just now, like the owner gave money to the business owns that money, but at the same time, it owes it to the owner. And when the business, whatever the business, which is separate from the owner, owes to the owner, we can say is the owner's equity in the business, the owner's interest in his own business. All right, there's other possibilities that our business can also owe money to outside parties, outside businesses. Let's say the business buys a computer, a laptop on account or on credit from a computer supplier. Then the business now has a computer, which is an asset. Our business owns that asset. Lovely. But at the same time, the business owes the money to that computer supplier. We bought it on account or on credit. So yes, we own the laptop or the computer, but the business owes the money to that outside other business from whom we bought the laptop. Now, when our business owes money to another person or a business which is not the owner, we call that institution or that element a liability. So our business, and that's what the accounting equation is about, what the business owns or has is equal to what the business owes, either to the owner of this business or to outside parties. And that is what the accounting equation is about. I hope that cleared a couple of things up for you. Let's continue then to the next one, where we're now going to look at the accounting equation. And we will forever, when we are busy with accounting, we will refer to the accounting equation. We will refer to the double entry principle. We will refer to asset, owner's equity, and liabilities forever and a day. So I tell my students, go sit on your bum, study this thing until you know it from the top of your head. If I wake you up at night, you must be able to literally recite everything that's on this page. And people, if we look at this, you need to learn this, but this is not a lot. This is not a lot. So if you can learn this, I promise you the rest of the stuff will make sense. You can take my word for it and come back and tell me if I were wrong, but I know I'm not. So let's quickly have a look at the different elements of the accounting equation. Now you will see here at the top, we've got our accounting equation, which we've just started to unpack on the previous page. Now, assets equals owner's equity plus liabilities. What the business owns is equal to what the business O's. And you're going to see now it's going to make more sense. Right. Now, remember we said that one of the other principles is for every debit, there is a credit. Now, this is where that story comes from. In accounting, we work with something, and if you're in grade 8, you'll get to that. Grade 9, you've dealt with that a lot. We work with something which is called a general ledger account, and it literally looks like a capital T, and there you can see it. Now, way back when, in the early days, when accounting started to originate, there wasn't something like a cash receipts journal and a cash payments journal and all the other subsidiary journals. Businesses, small businesses, recorded their transactions directly into these ledger accounts. Now, the ledger account is just like a T account with a left-hand side and a right-hand side. Left-hand is debit, right-hand side is credit. And every account has a name. And these names that you see here, those are all names of accounts. So every account or every transaction that we deal with in our business is related to a specific account. So when a transaction takes place, it affects a specific account. And now more specifically in accounting, it usually affects two accounts. For every debit, there must be a credit. So in the business's books, when there's a transaction that takes place, somewhere in one ledger account in the business's books, we will write that transaction on the debit side of an account. And somewhere down the line in another account, another ledger account, we will write that same transactions amount on the credit side of another account. So for every debit, there's a credit. And the reason why that should happen is so that the accounting equation balances out, so that what's on the left-hand side of the equation is ultimately equal to what's on the right-hand side of the equation. Okay, let's have a look. Assets. What are assets? People, assets are, and we've already determined a little bit about on that, assets are things of value that the business has or owns. Remember, this is all business. Né? We look at it from the business's perspective. Now, we basically have three types of assets. We call them fixed assets. In some books or textbooks, they talk about non-current assets. Now, fixed assets are those items of value that our business buys with the intention not to sell it again at a profit. We buy those things for our business so that we can run and operate the business. Usually they've got a long lifespan, longer than a year. And we usually list them in this order: land and buildings, vehicles, equipment. I tell my students from big to small: land and buildings, vehicles, equipment. Yes, of course, if you buy a delivery vehicle for your business and after a few years this thing is now starting to fall apart, you need to buy a new delivery vehicle, you can definitely sell that vehicle. You can buy a business property and later sell it. But the intention is not to sell it when you originally buy it. No, you're going to use it within the business. So those are our fixed assets. People currently, what I want to say, if I say forever, always, etc., etc., this has got an expiry date until the end of grade 9. After grade 9, we're adding some more things if you move on to accounting in the FET phase. So please just keep that in mind. If I say this is forever, it's forever until the end of grade 9. So those are the three fixed assets for now. Okay, if we move on to current assets. Current assets are short-term assets, meaning the following. It's either, so it's got value for the business as well, but it's either cash, money, cold hard cash, or can be converted into cash within a year. That's the definition for a current asset. Now, grade 8, you're not going to deal with trading stocks straight away, but learn this so long so that you are aware of that. Trading stock are those things that we will buy for the business, or will buy as the business, in order for us to sell it at a profit. So If we think of a SPAR, all those grocery items, toiletries, meat and whatever, all the things that SPAR buys in order to put it on the shelves to sell to the clients is SPAR's trading stock. If you have a clothing store, all the clothes on your shelves will be the business's trading stock. Okay, just for interest sake, if you have a car dealership, although you see vehicles there, if you have a car dealership, the cars on your floor, those cars will be your business's trading stock. So it depends entirely as to what type of business you have and what your type of trading stock will be. But trading stock are items that we buy, the business buys, in order to sell at a profit. The next one you will also only be dealing in grade 9 and in term 2. And that is debtors, or the, how can I say, the collective noun is called debtors control. Now, a debtor is someone who owes money to our business. So typically, if your mom goes to Milady's, she's got an account with Milady's, and she buys some clothes on account, on credit. She swipes her card, the Milady's store card. She buys those clothes on account from Milady's. Your mom is a debtor of Milady's because your mom then owes money to Milady's. Okay, so that is a debtor. Now you might think, but how can somebody who owes money to our business be an asset to our business? That does not sound right. And I know it sounds a little bit off or a little bit funny, but indeed, in terms of business and accounting, we do regard the debt of a client as an asset to the business. Now, well, actually, I should say we are all believers then, and we do believe that if somebody buys something from our business on account or on credit, that they will pay their debt. And therefore, we already the transaction, the sales transaction has already materialized. The client has taken our stock. All they now need to do is to pay back the money, pay their debt. So in accounting terms, we do regard a debtor's debt as an asset, as strange as it might seem. And obviously, if you're in grade 9 in term 2, we go through a whole lot of procedures to explain that everybody who comes into our store is not just going to get an account and can buy on credit. There's a lot of procedures that we put in place. So we believe that the people who do owe us money after we've sold to them will pay us back. All right. And then the last 3 are cash accounts already, or cash in the business already. If you see bank, it means it's our business's money at a commercial bank. So in an account at a commercial bank. So maybe we have an account, our business has an account at ABSA or FNB or Nedbank, and there's some money in it. It is cash already. Definitely an asset to our business. Cash float is that change, so also money, or that small money and coins and notes that we put in our till every morning in order to give change to our customers. Petty cash, now many businesses have that. It's literally a small container or one of those small money boxes that you can lock, that either the financial lady or the secretary or the accountant or whoever keeps that obviously in a safe place. So when it's somebody's birthday and we quickly want to run over to the home industry to buy a cake, or it's tea time and now we realize there's no milk, and we quickly send somebody over to Spar or Pick n Pay to buy a liter of milk. Those small payments that we might not necessarily use the business's bank card for are paid out of the petty cash. In grade 10, you learn how to restore the petty cash journal and how everything works. But for now, you just need to understand and know that petty cash is the small money that we keep in a container in the store or in the shop or at the business. And then financial assets, just be aware of them. We're not really dealing with them on grade 8 or 9 level, but those are almost, I can say, long-term cash accounts, or long-term bank accounts. So it's money that you put in a fixed deposit or an investment account. So it is cash, but we normally make that deposit or do the fixed deposit or investment for a couple of months or years. So it's not always readily available, but it's definitely an asset to the business. Okay, now the rule for assets, for any asset in our business, if an asset increases, if an asset gets more in our business, we will write, and we will get to that, we will write on the debit side of that account. That's the rule for assets. Whenever an asset decreases, we will write on the credit side of that asset account. So this is the rule. The assets, debit plus, credit minus. Okay, and I will get to the other two now, and you will see how easy this subject really is. When we look at owner's equity, so remember, now we said that owner's equity is actually the owner's interest in his own business. So the part that he has in his own business. Now, when it's a sole trader, everything that the owner has put into the business is due to him, or the business owes to him. But obviously, if the business later owes money to outside parties and businesses, the equation expands a bit. Now, remember we said that we need to keep the business's transactions and the owner's personal transactions separately. Now, in order to do that, we allocate basically two accounts in the books of the business, but through all the other accounts, or with all the other accounts, we allocate two accounts to keep record of what the business owes to the owner. All right, now the two accounts are capital, and we call them some direct owner's equity. It's got directly to do with the owner. So whenever the owner gives money to the business, so when he starts up the business, he makes a capital contribution. He gives some of his money to the business. We call that capital. Throughout the lifespan of the business, or the existence of the business, the owner can give more money to the business, maybe for the business to expand, or whatever the case might be. So every time the owner gives money to the business, it will be recorded in the capital account. And do you agree that when the owner gives money to his business, the capital in his own business is increasing? The owner's capital contribution in his own business is increasing every time the owner contributes capital or money to the business. It needn't always just be money. The owner can also contribute equipment or anything else, but mostly on grade 9 level, we work with money that the owner puts into his own business. Now, remember, previously I said it can also happen, especially when small businesses, that the owner, for some or other reason, uses the money that's in the business's bank account, because he's given it to the business long time ago. Now the money is in the business's bank account. For some reason, the owner now uses the business's bank card to buy something or to pay something. Or he makes an EFT from the business's bank account to whoever he needs to pay. It can be that he's booking a holiday, or he's buying his wife some flowers, or pays his son's school fees account from the business's bank account. That is then regarded as drawings. In the books of the business, there's a drawings account, and that means the owner, who has given capital previously to the business, is now actually withdrawing some of that money again, for whatever reason it might be. Do you agree that when the owner draws that money, or pays personal stuff with business money, the business now owes the owner less? His owner's equity is decreasing. So capital will increase the owner's equity in the business, and drawings will make it less if he takes some of the money out again. Okay, so those are the two direct owner's equity accounts. Secondly, we have two set of accounts which we literally call indirect owner's equity. And what that means is the following. These two set of accounts affect the owner's equity. Now, if we look at incomes, whenever the business generates money or an income, or gets an income, do you agree that there will now be more money for the owner to eventually take home? So all incomes have the effect to increase the owner's equity in the business. And people, that's why some people start businesses, so that their investment can grow. So this is what I put in the business, but now we are trading and we're delivering services and whatever else. And now the business generates an income or makes a profit, and therefore the owner's equity, what is due to the owner by the business, is increasing. So all incomes that the business might get in some or other way will increase what is due to the owner, will increase the owner's equity in the business. And there's many different types of incomes. Current income is when our business provides a service to our clients, hair salon, electrician, plumbing business, pet sitting, something like that, where we don't physically sell something, our business provides a service. That money that we get from providing a service is called current income. When our business sells to our clients, when we trade, that income that we get from sales increases the owner's equity. And then there's a few others. We can sublet perhaps a part of our property. Maybe we work on a commission basis for a supplier. We can earn commission. It has happened that people like a business so much that they make a donation. I don't think it happens often, but it could. And then if you've got money in the bank, your money, the business money, can attract some interest. If it stays there for a while, you can get a little bit of interest. So all of this will make the owner's equity of the business more. What is finally due to the owner, it will increase. Unfortunately, as with real businesses as well, there's lots of expenses within a business. Every day, things that the business needs to pay in order to operate and keep its doors open. This one is cost of sales. Now, cost of sales is linked to sales. The moment we sell something, there's an expense part to a sales transaction. Grade 9s, we will shortly get to that. Grade 8s, just be aware of the name. Then there's lots others: telephone, trading license, stationery, salaries and wages, water and electricity, rent, expense, repair work, fuel or petrol, advertisements, the list goes on. So all these things that the business needs to pay or sometimes buy in order for the business to operate or run on a daily basis, all those things make the profit of the business smaller or less. And ultimately, there's less money or less owner's equity for the owner. There's less for the owner to take home at the end of the month or at the end of the year. So people, that is why it's important to keep track of the business's expenses. The more expenses there are, the less profit this business will show, and therefore the less money is owed to the owner by the business. So we must try and limit expenses within the business. All right, now the rule for owner's equity is as follows. Anything that decreases the owner's equity, we will record such a transaction on the debit side of that account to show that there's now less money due to the owner. There's a smaller interest of the owner in his own business. Anything that will make the owner's equity more or increase within this business will be recorded on the credit side of that specific account. All right, now what can you see here already? Assets, debit plus, credit minus. Because this is on the other side of the equation sign, the rule is opposite. Owner's equity, debit minus, credit plus. Lastly, we look at liabilities. Grade 8, we don't really deal with liabilities in your year. Grade 9's only in term 3, but you need to be aware of this. And once again, even if you, or when you know this poster and you know the principles, even if you have not come across a specific transaction or your teacher hasn't explained it in class yet, with this knowledge, you can actually figure out what's going on. And this is the brilliance of the subject. Know the basics, and I can give you anything, and you can determine and work out what the answer should be. How nice is that? Okay, next one, liabilities. So liabilities is now, remember we said owner's equity, what the business owes to the owner. Liabilities is what the business owes to outside parties, other than the owner. Now, we again have two types of liabilities, non-current or long-term liabilities, and that is debt that our business owe, or money that our business owe to other businesses, which we're going to pay off over a period longer than a year. And that's typically if we have a mortgage bond. So if our business bought property, a building, a piece of land, or something like that, some of your parents might have home loans, which they pay off over 20 or 30 years. That's definitely long term. Often in business terms, because businesses are volatile, times are really tough, banks would probably give businesses 10 years, I would say maximum 15 years, to pay off a property bond, like a commercial property bond. But obviously, it's a long-term liability. Né? And then also, if you take out a loan, say example, for example, from a bank, a two-year loan or a 5-year loan, maybe you applied for a loan to expand your business, that would be regarded then as part of a long-term liability. Then current liabilities, still money that our business owes to outside businesses or people, but we're going to service that debt or pay the money back within 12 months, usually within 12 months. So that is current liabilities. There's a couple. The first one is creditors, the collective noun creditors control, and that means it's all the money that our business owes from buying on account or on credit from suppliers. So we owe those businesses and we call them creditors. Creditors control just all that money that we owe to those suppliers that we put together. So that's a short-term liability. Then the next one is bank overdraft. Now you will remember that we've spoken about bank as an asset. So now how come this is happening here? Look at the word overdraft. That means, say now our business, obviously we have a business's bank account and there's money in the bank account. As long as there's money in our business's bank account, it is regarded as an asset to our business because there's cash, we have the money. But it can happen, maybe some months are tougher than others, or there were lots of expenses or unexpected purchases that the business had to make. And now literally the balance in the business's bank account comes to R0. There's like nothing left. If the business has got an agreement with the bank, and that would result in a contract being drawn up and signed for and credit checks being done. So it's not just something that happens overnight. As a business, you have to apply for an overdraft with your bank. So this means the bank will check your financials and say, okay, listen, it looks as if you are credit worthy. Let's say we bank with FNB. FNB will say, all right, we're going to give this business an overdraft of 10,000 Rand. This means once the business's money in the bank account is like zero, it's used up, then FNB allows our business to use FNB's money up to 10,000 Rand. And the moment our business starts using FNB's money, then it means our bank account, probably you've heard of it, goes into the red, goes in the red. And that means we are now in a bank overdraft. Our business has a bank overdraft. So the moment you start using the bank's money, FNB's money, then bank is not an asset. Your bank account is not an asset anymore. It now has become a liability because our business owes that money to FNB. All right. And obviously, as soon as maybe we receive some money in and our bank balance goes into a positive bank account, green, it's not, or black, it's not in the red anymore, then bank becomes an asset again. We don't really deal with that on grade 8 or 9 level, but I always expect my students to know that, and that if you have that knowledge, then it does make sense as we go along. And then the last one, maybe you come across an excellent business opportunity, the opportunity to buy stock at a very good price or something like that, but you need some financing. You can apply for a short-term loan, 3 months, 6 months, 9 months, anything less than a year. And that will also be regarded then as a current or a short-term liability. Okay, people, it's a mouthful, but this brings us to the end of our first video recording. And I really hope that I could demystify a couple of things for you within this lovely subject called accounting. And I will continue to post then videos on certain topics. The next one that we'll do will be specifically on analyzing transactions and what effect that will have on the accounting equation specifically. So here we are. Just to end off, liabilities rule, the T account rule is exactly the same as for owner's equity because they're standing on the same side of the equation. And because both of these two elements are where the business owes money to them, owner's equity or to outside parties. So their rules are exactly the same. I'm ending off with this. Yes, you need to know this poster off by heart. No arguing about that. It's something you have to do. Secondly, you need to know the 3T account rules. Assets, debit plus, credit minus. Owner's equity, debit minus, credit plus. Liabilities, debit minus, credit plus. Can I challenge you, grade 8s and 9s? Learn the asset rule. Debit plus, credit minus. If you can remember that one rule, what else do you need to remember? That the other two are the opposite. I always tell my students, the moment you start with accounting, whatever you do, you draw your 3T accounts. Draw the asset one. That's the only one you need to remember. By then, just swapping the signals for the other two, you'll have that covered as well. Okay, I hope to see you again shortly in some of our other video recordings and presentations. Take care.